Your money is not restricted like you are. So your money can work 24/7. The only reason people want more money is to buy more time. We are doing the exact same thing a traditional bank does. It's not doing this or buying real estate or doing this or investing in stocks. It's this and that. You don't need to make a decision. This is just changing where your money starts, and you're still doing everything you would do normally. You'd invest in things you know, like, and understand. What's going on, everybody? It's another week, another wealth webinar where we're going to educate you on the truth about money and how money really works. And I think, this show has been going on for years and years and years. We've never missed a Wednesday, and we just keep expanding what we teach on. But today we're going to come back to 3 basic things. I think you all are going to love what we're going to talk about today. But we're going to talk about the product, we're going to talk about the process, and we're going to talk about the problem. So before we get started, I want to just kind of check the room. How many of you are here for the very first time? Put I in the chat. We got almost 100 people. So there's always a bunch of new folks. So who's here for the very first time? All right. OC, KL, Renee, KL, Johannes, Albert. Fantastic. I might have missed a couple of you, but I think I got John, Thomas. Great. So thank you for all you brand new newcomers. We love having new folks around the campfire, and we are sure to deliver some really, really useful stuff. The one thing I can tell you with this show that we never do, there is no pitch. So if you're brand new to this, I just want you to know, like, if you're waiting, you're like, all right, they're going to do the pitch at the end. There's no pitch. We have pulled the pitcher from the game. This is all education, folks. That's what this show always is. It's where we give our best stuff away for free, and that's what we're going to do today. So let's dive in. So real quick, when we talk about the 3 different things, the product, the process, the problem, one of the biggest things we teach people is we teach them how to take back control of their money, and we do that by teaching you how to be the bank. To be the bank involves 3 things, but can any of you tell me what the number 1 most important thing is that we must focus on? Is it the product? Is it the process? Or is it the problem? In the chat right now, tell me what you think the most important thing of the 3 Ps is. Love it. There we go. So OC got it right. So OC's here for the very first time. So put your hands together for OC. I'm hopefully saying your name the right way, but the problem. So I noticed a bunch of people said the process, and I can totally respect that. OC said Ozzy. Oh, Ozzy. Wait, that's way easier. Ozzy, that's the name. All right, so Ozzy got it right. Thanks for being here for the first time. And I love Jerry said mindset. So when we're talking about the product, the process, the problem, the number 1 most important thing is the problem. Every single time we get on a call with a client, which we do hundreds of times every single week, the most important thing of that call is that we understand what problem are we solving for you. That is always the thing that we must focus on. Then from there, the second most important thing is what process do we have to go through to solve your problem? And then the very least important thing is, well, what product solves the problem that we're trying to fix here? What product makes this happen the most efficient way? I just did a talk out in Indianapolis to a bunch of peers, and the very first thing I said from stage is I said, who in this room sells a product? And a bunch of the agents and the advisors raised their hand. And I didn't scold them, but I was going to say, shame on you. But I didn't, because I was trying to be nice. Because if all you do is sell a product, all you're trying to do is pay yourself. That's it. Okay, so the product should always be used just to solve the problem. That is it. So the most important thing is the problem. And we're going to talk about 3 specific problems in today's trainings. Okay, number 1 problem we're going to talk about is income. Everybody has an income problem. I don't care how wealthy you are, you want more income. So if your problem is income, you want more income, great. We're going to talk about how to solve that problem. But we're also going to solve another problem at the same time as we're going to talk about retirement. How do you solve the retirement income problem? So we're going to go to the master, or not the master. I'm going to call him a fool today, as when you see why. But Dave Ramsey. Dave Ramsey likes to think he's the master of everything. And Dave Ramsey, love him or hate him, I'm going to prove to you today that Dave Ramsey is wrong. He is completely wrong in the advice he's giving his folks when it comes to income and specifically retirement income. So that's the second thing. And the last thing we're going to cover today is we're going to cover a car. We're going to literally show you a problem, which was a real client's problem that Craig was working with Brandon on. And it was a guy who wanted to buy a car. And he was looking at buying two different cars, and he wanted to know what's the most efficient way for me to buy this car. So that's going to be the final thing. And then as a bonus, we're going to talk to you about how do we design this entire thing for the maximum efficiency, because that's the most important thing. If we're going to solve a problem, we want to solve the problem the most efficient way. Craig, is there anything you want to add on to what I just said? The process, the product, the problem.
Those three things you talked about, the problem, the process, and the product, they really encompass the solution, right? So when we identify what the problem is and we identify the process that's going to solve that and the product that's going to help in that process, that is the solution. And I don't know who mentioned it, but maybe as Andy said something about the solution is the most important. But yeah, all those things combined together are the solution. But I think our point today is we just want to make sure we're focusing on what is your specific problem that we're trying to solve first. Right.
Yeah, and Jim, I'll have Craig put up a link. So if you want to get on a phone call with one of us, that's no problem. We'll put a link up so you can do that. But again, I really want to spend the majority of our time today just focusing on how do we solve different problems the most efficient possible way. And I agree with you what you said, Craig, there. And I can't remember who said the solution. That's epic. Solution. So we're solving a problem, but in solving a problem, that involves a solution. So that is where I'm going to go next, if that's okay with you, Craig. So
let's do it.
When we're talking about a product, a process, a problem, the first thing we want to identify is a problem. So let's just start with over here in this box. We'll just start with, this is your problem. Now, your problem can be lots of things. It could be debts. Lots of people in America have a major debt problem because, well, inflation kicked in when the Fed printed $5.2 trillion, kept interest rates really low. Everybody went on a little buying spree, and that drove up the cost of things because it's all just supply and demand. There was a lot of demand and there wasn't enough supply. So that, because of the pandemic, that drove the price of things up, but really it didn't. So that's what most people think inflation is, right? They just think the price of things goes up, which I understand, because from our viewpoint, that's exactly what it is. You went to the gas station before the pandemic and gas was one price. You now go to the gas station and it's double. Or you go to the grocery store and you used to buy eggs for one price and now you go and they're, well, almost double. So for the blind eye or the trained eye, depending on how you're looking at it, it is a price thing, but it's really not. Because what inflation actually is when they print a whole bunch of money, the money that we have in our bank accounts, in our retirement accounts, it just, every time they print a dollar, it steals a little bit of value from your current dollars. And every time they print more and more and more, all it's doing is it's stripping value from your current dollars. I'm not doing a very good job of ripping this thing. So eventually, over time, with inflation, our dollars buy less, because their value of our dollars is diminished because new dollars are printed out of thin air. That is literally inflation. It is a hidden tax. So now that we've got that out of the way, the one thing that always solves the problem of increasing prices or inflation is more income. It's the one problem that will never get old, because if the price of things goes up, not a problem if your income goes up more than the price of things, right? Does everybody agree with that? So what if we just had a problem of, well, we want more income? Well, great. So now we got to find a solution to more income. So let's talk about some of the solutions. Well, you could go out and get a second job. How many of you want to get a second job? Ozzy, you want to go out and get a second job or third job? You want to work overnight shifts so you get double or triple time? How about that? Nicholas, you want to go get another job? How about two jobs? So Ozzy said, heck no. Nicholas, you want a second job? Probably not. So that's not efficient. Okay, so if you don't want a second job, you could always go into your boss and you can ask for a raise. How many of you want to go into your boss and ask for a raise? Or how many of you that own businesses want to go to your customers and say, hey, listen, I got to increase your cost. I got to charge you more for this service or this product because, well, I need more income. How's that going to go, right? I love that. Andy said, I don't want the first job. Well, great. So let's replace job with something that you love. That's one way to do it. So none of you want that. So what if we don't want to get another job, we don't want to charge our customers more or tell them we have to raise our costs, to them. None of those sound good. I mean, some of you don't even want the first job. So great. What would the solution be? Craig, if they don't want to get another job, just like we don't want to get another job, they don't want to probably work overtime, double time, overnight shifts, any of that stuff, and they don't want to charge their customers more. So what would be the solution?
Well, one idea would be to, well, I love Nicholas, rob a bank. I mean, that's always an option.
Sure. We could
Now,
just
one we
become
would,
the bank, but don't
yeah,
ever
we
rob
wouldn't
your own bank.
recommend. We
What do you
could
think?
put our dollars to work. So
Yeah,
we may not work, but what if we put our dollars to work?
I love that. All right. So, and folks, listen, like this isn't pre-rehearsed. We're just kind of having fun here. So one way to make more income without working harder, longer, or taking on any more risk or charging your customers more or getting additional jobs would be to make your money that you currently have now work harder. Listen, we don't want to work harder. Like we want to spend time with our family. And let me preface one thing. The only reason people want more money, okay, and I want to make sure I got the right audience here because we got well over 100 people. The only reason people want more money is to buy more time. Does anyone not agree with that? You want more money, more wealth so that you can buy back more time. Isn't that the most accurate description of why we want more money? Does anyone disagree with that? It's spot on, Ozzy said. And Ozzy's absolutely correct. The only thing in life that means anything is time. Time with our loved ones, time doing things we love, time that we spend out there with our loved ones, and then doing that. Well, you can't do that if you're working a second job, a third job, overtime, night shift, all that. You can't. So the only way to do this, and every wealthy individual you will ever meet has figured this out. The only way to do that is to make your money work harder for you. Your money is not restricted like you are. Your money doesn't have to eat. It doesn't have to poop. It doesn't have to pee. It doesn't have to take vacations. And hell, it doesn't even need to sleep. So your money can work 24/7. But with your money working, we have to put a set of parameters around your money working for you. So in order to get your money working for you 24 hours a day, 7 days a week, we also must consider risk. Your money can work for you, but your money working for you sometimes involves risk. So I don't know if I'm different than any of you, but I don't want more risk. I want less risk. I want my money working for me in the lowest risk. If no risk was an option, I'll take that option. No risk. And I want my money working for me 24/7, no matter what. So if that was your plan, if that sounded good to any of you, what we need to do is now we have identified our problem. Next thing we need to do is put a process in place to solve that problem. And we're going to need a product that will allow our money to work for us in a guaranteed environment, 24 hours a day, 7 days a week. Is there a product that anyone knows of that will allow us to earn guaranteed interest or guaranteed returns on our money in an environment that's tax advantaged, that doesn't get affected if we happen to use the money, need the money? I mean, is there anything that exists like that? Because a bank account doesn't work that way, Craig. If I put money in a bank account and then Craig, you come up and you say, hey, Chris, dude, this guy's got this amazing Porsche. He's going through a divorce and he's got to sell it. You can get it like 80% off. Like now, do you think I want to keep the money in the bank? No, I want to take the money out of the bank and I want to buy that car. So in doing that, when I take the money out of the bank, does that mean my money stops? It's no longer working for me, right? Sure, right. I get a car and I bought a car at a discount, but my money can't work for me anymore. So a bank account can't do that. I don't think a 401k, I don't think I can put money in a 401k, take it out and have that money still earned for me. Can't do that in a stock account, a brokerage account. Where can I do that? Audience, Ozzy, where would be the only product that we could use where we could earn uninterrupted compounding interest in a tax-free environment? John said real estate, so we'll cover that in a second. Nicholas said whole life insurance, but I like Robert's answer, specially designed whole life. So if that was our problem, income, Okay, and we wanted to put a process in place, which we'll get to in a second, but that process has to involve a product that's the most efficient to solve the problem. So the solution to the problem actually is the product in this, but it's the product and the process. That product would have to be a specially designed whole life. Now, a bunch of you on here are probably like, what in the hell just happened? I loved where he was going, but now all of a sudden he's talking about a product, and a product that Dave Ramsey says is a piece of crap. So what I'm just suggesting, and I'm just going to draw it right here. And Craig, if you could get that illustration up of a properly structured, designed whole life, I'll come to that in a second. So what we're suggesting is all of you make money. You make money in various different ways, but that money goes somewhere. And right now, I'm going to guess the first stopping place is somebody else's bank. Bank of America, Wells Fargo, Chase, all those. Your money's going to the bank. But the problem with the bank in the example I just gave of the car, okay, so I'm just going to kind of draw a little car here, is if I take the money out of the bank and I buy the car, my money no longer works for me. So let's just say the bank was paying me 3%, which pretty soon is going to be a lot less than 3% because the Fed just dropped rates 0.5%. And they're going to drop them another probably 0.5% before year end. So not going to get into that, but if we take the money out to buy the car, our money loses earning potential. So if we want to solve our problem of more income, one of the things we may want to consider is changing one thing, and that is where our savings goes first. And we're going to put that into a specially designed whole life insurance policy. But I still have not told you why we would use a whole life. So Craig, I'm going to give you sharing ability. If you could just pull up, folks, there's no rhyme or reason to this design that we're going to pull up here. This is just to kind of show you how we build these, because this is not the whole life that your broke-ass brother-in-law or broke-ass sister-in-law tried selling you the last time you were around them. These are specially designed and engineered to do one thing and one thing only, and that is provide maximum cash value growth. So Craig, you want to talk through this real quick? And can you make it a little bit bigger? Because some of our eyes aren't so good. I'll put my glasses on, but other folks might not have glasses.
Yeah, let me get
that's
this
better.
maximized here. All right.
And I do want to, and Craig, I do want to come back to there's a couple of folks in here saying apartment buildings and real estate, and I'm totally in agreement with that, but that wouldn't be the first place. Because let me just hit this real quick, and I'm going to talk this through. So Craig, keep your share. If we were going to buy, I did a car, but let's just say we're going to buy an apartment building because we want more income, and we know real estate can give us more income. The first thing we would have had to have done is saved up money in a bank, and then we'd have to take a withdrawal from the bank and buy the real estate or put a deposit down on the real estate. So the same problem exists for real estate because we're talking about a fundamental starting place for our money. We want our money to work for us. Remember the problem, we want more income. And the way to get more income without working harder, longer, or taking more risk is to get our money to work 24/7 in an environment that does not get taxed, in an environment that provides guarantees, and in an environment that earns uninterrupted compounding interest, which also means that environment can't be a bank, because when we take money out of a bank, they stop paying us interest. So we're going to come back to that real estate in a second. So I'm going to leave that right down here, but I'm still suggesting that the first starting place for your money is the specially designed and engineered whole life versus the bank account. And Craig's going to show you exactly why.
So this is the kind of the first place, Chris was just showing us where we can take our money out of the bank and go directly to buy an apartment complex. We can take our money and go buy a car. What we're talking about is we want to take those dollars and first put them into the specially designed whole life policy. And this really gets down to the product. We're going to design the product to solve as part of the solution to solve that problem. So just as a kind of a basic understanding, this is not an illustration. This is data taken from an illustration from an insurance company. But essentially what we do is we come up with the funding mechanism. So how much do you want to put into your bank, either monthly or annually? So what we're doing here is we're saying we're going to initially put $99,000 into our bank. So it's just like when you go open up a savings account. So Chris, if you open up a new bank at, say, Wells Fargo, what's one of the things they always ask you? How do you want to fund this?
Yeah.
All right. So we're going to take that $99,000 that's in our, our pocket or in a bank, and we're just going to drop it into the specially designed whole life policy.
Well, hold
Now
on. Let
there's,
me go one step further with that, Craig, because that
okay,
brings up a good point. And somebody in here, I think it was Freddie, mentioned a credit union. And so credit
yep,
unions, we talk about them all the time because they typically will pay a member of a credit union a higher interest rate than a traditional bank. So Craig, in an example where somebody had, like this example, where they had 99 grand in
mhm,
a giant commercial bank, but somebody told them, hey, this credit union down the street has got a bank account, a savings account that pays 3.5%, which is 3.5 times more than what your commercial bank is. They would easily go into that credit union, set up an account. The person setting the account up would say, well, how would you like to fund your account? And I would like to move the money from this bank account at the commercial into the credit union. So we're kind of talking about the same thing, except for we're replacing a credit union with a giant mutually owned insurance company that pays dividends, correct?
that is correct.
Just
And
wanted to kind
here's,
of make sure I answered that.
but I think another thing that might be relevant to talk about at this time is, so that credit union might be giving you 3-4% now, but do you expect that to always be the case for the rest of your life? But what if this bank that you created guaranteed you 3.25 for the rest of your life? Wouldn't that be cool?
Forever. Can't change.
Forever.
Doesn't matter what the Fed does. Because listen, I use a credit union and I love my credit union, but I keep very little money in there. And I keep very little money because everything is tied to the Fed rates. Everything is tied to prime. So if the Fed drops interest rates, I know for a fact I'm going to go into my bank account at that credit union and I'm going to look at what I'm getting paid. And now today it's less than it was 2 weeks ago because the Fed just dropped rates.
Yep.
Guaranteed.
Yep.
Where here, the insurance company gives you a contract with a stated guaranteed interest of 3.25 in this example we're given. That's a great point.
Yep. All right. So essentially what we've established is we're going to take this 99,000 out of our bank, our credit union, and we're simply going to put it into another bank, which is our bank. And so now that 99,000 just gets dropped in day one. And there are certain design considerations. We're not going to get into the nitty-gritties on that right now, but you can't go put $1 million in and then put in, 5,000 for the remaining, life of the policy. So there's some design considerations. And guess who set that whole thing up where we can't do those large dump ins with tiny bits of premium going forward? Well, our good friends at the IRS, right? Yep, our good friends at the IRS put some guardrails around the designs of these policies, because back in the 80s, wealthy people were just dumping hordes of money into these policies. And the IRS said, well, we're kind of losing the tax advantages here, so we want to share in some of that. So they put the guardrails up saying you can put a certain amount of money into the policy related to the premium. So that's why you see there's a $99,000 dump, and then we've got it structured to put in 20,000 in addition to that 99,000 going in year one. And then you'll see year two and on, beyond, as we're putting in that 20,000.
And folks, just so
Now,
you all know, this is just an example. Like when you build your banking system, kind of like what we're showing, what we did here, that 20K can be pretty much any dollar amount you want. In this example, we're maxing it out. So in other words, to dump in the 120 in the first year, 20 grand would be like that. You'd have to build it at 20 grand because, as I'm going to say, Ozzy said it, the government, the IRS, will tell you how much your limits are. So this is like an optimally funded a whole life policy, like a specially designed whole life that is built for maximum efficiency. And you'll see that in just a second.
Yep. Now, what would this look like if, Chris, you talk about this, Brent Kessler talks about all the time, your broke ass brother-in-law that sells life insurance policies, what would they do? Well, they'd take this $20,000 and they would put that full $20,000 towards what's called the base of the policy. If they were to do that, do you see these numbers over here, like this dividend number of 903, this projected cash value? Guess what those numbers would be if you design this in a normal fashion, a normal whole life policy? Well, that'd be zero. And this would be zero. There wouldn't be any cash value. There wouldn't be any dividends for the first few years. So this is what makes it specially designed and engineered, is that we take some of that 20,000 and we break it into what's called the base. And there's this special rider called paid up additions. That's what creates the dividends and the cash value, creates that high cash value early in the policy's life. So now that we've identified how we're going to fund our policy, let's just kind of take a look at it, how it works over the years. Now, as you look at each row, oh, go ahead. Oh, as you look at each year 1, 2, 3, and these are always reflective at the end of the year because the dividends are paid at the end of the year and all the growth is built at the end of the year. But for this particular design, we're saying by the end of year 1, we've put in $119,000. In the contract with the insurance company, they will guarantee that if they never pay dividends, which they've always done for 120 years, that you will at least have this as a guaranteed. Now, these columns don't really apply once we start getting dividends because all of that's going to be even bigger. One thing that you'll find in your bank, just like a savings account, it's not going to go backwards. Now, a savings account can go backwards if you withdraw, but if you have $10,000 in a savings account, you have $10,000 in your whole life policy, they're going to behave the same way. They're always going to go up. It's just how much are they going to go up? And are there tax advantages? So now we've got our guaranteed cash value. We've got our guaranteed death benefit of about 3.1 million. And at the end of the year, this is projecting that there would be about $903 paid out on the dividend. Now that dividend is going to be used to build more death benefit, more cash value. So that's just going to keep compounding and growing. It's this big snowball that we're building. So by the end of year 1, you've put in 119,000 and you have 109,000 of cash value. So Chris, I want to just stop here because I'll bet you a lot of people right now are saying, who in the world would put in $119,000 and only have 109,000 available? Why would you do
come on, Craig. I mean, that's stupid. I mean, you put in 119 and you only have 109. That means you lost $9,819 of your money. You don't have access to that. Well, I can tell you who would do that is the person that understands that building wealth is not a sprint, it's a marathon. And the person that understands that I'd rather make more money into the future than have everything today. And you know, the other thing too that's kind of funny, the other thing that's really funny is I don't know really anybody that takes their money, puts it into a bank account, and then goes back in at the end of the year and takes all of their money out just to say, I told you so. I don't know a single person that does that. Most people put money in the bank. They know they have access to it all, but they very rarely take all of it out and use it. So really, it's a mindset problem when people find a problem with this, because as we get into these numbers, like I'm the kind of person that, listen, like I want an account that when I put that 20K in each year, my savings, and this is assuming I'm saving 20 grand, I put 20 grand in, I want to be able to go in and take more than 20 out. And the next year I put 20 in, I want to take even more than I did the last year I took that money out. And I want my money to keep going up. But the most important thing, which we haven't got to in the process yet, is I want my money working for me 24/7. And I don't want any disruptions, but I still want to buy things. I still want to invest in things. I want to buy more real estate, but I want to be able to buy that stuff without any interruptions on this awesome guaranteed interest and dividend that you're talking about.
Yep, absolutely. So it is a long-term game, and we're going to show you how this long-term game plays out. And think of this whole session today, we're just building a foundation. We're building out the product. We're going to then show you a process, and we're going to show you what it solves. So as Chris shared, yes, we're not getting 100% of our money out, but why would you put money into a bank and then pull it right out all the, 100% anyway? It wouldn't make any sense. Now, what's going to happen is we've got this column that we're measuring called cash on cash, and that's exactly what Chris was talking about. Is at some point he wants to put in 20,000 into the policy that year and have more than 20 to pull out. And so within the first year, we've got about 91% available of what we put into our banking system. It drops a little bit in year 2 because of the dump in that we put in, and we injected a big dump in. But then look what happens at year 3. This is, oftentimes we call it the money tree. Because of the previous years of compounding, when we put in 20,000 in year 3, we now have cash value growth of 20,255. So we're now getting more out than we put in, and that continues for the rest of your life. So it took a whopping 3 years to get there with this policy.
But here's the other thing, Craig, that I think a lot of people need to realize that's different than a bank is the only thing that can happen is your money is worth more the next year than every year it's going to be worth more. It can't do anything else. Even if you took all the money out, your money is going to grow exactly how you're shown. So listen, like this is where I think the rubber meets the road and where people kind of overcome that first mindset objective of, okay, I put 119 in, but I didn't have all my money. In the second year, I put 20 more in and I only had 16 of the 20. Like I feel like I'm losing. But then the next year they put 20 in and they can take 101% of that out. So they, they take 20,255. Nothing to write home about, but the next year is 22. I mean, listen, sign me up every day to a bank that I can put 20 grand in and then but in a year's time take 22,000 out. And the next year I know I'm going to be able to take 23 out and then 24 and then 25. Like, dude, that's what I want. And that's my money working for me 24/7 without me working any harder.
Step one is we're just putting our money in an environment where we have control, whether we take the money out to buy a car, to invest, to put our money to work. This is going to happen regardless.
And Craig, here's another thing that's really important here, and I want to just hit this. Let's just say, I mean, listen, we're going into some challenging economic times here. We've got a big election coming up in November, and then after that, I mean, it's pretty much almost certain we'll enter some type of a market correction or some type of a, just an economic correction, maybe a recession. I might need to change my savings plan. Like I can definitely do $20,000 a year now in savings, but next year it's uncertain. I just don't know. So what would be the minimum that I could put into this in order for this entire banking system to continue to operate?
So if you had a rough patch, you wouldn't necessarily need to put in the 20. You could go down to about, let's just call it 6,000. It's going to be in that ballpark. So you could really go anywhere from the 6,000 to the 20. So let's say you've got 12,000, then great, put it in. So there are some things you can do where you're not committed to that 20, but that's what we want to try to get to every year.
So I think getting back to the original reason we wanted to get into this thing, I don't want to get too bogged down in the numbers, but this is why we would use this specially designed and engineered whole life over a bank account or over a money market or over any other account. It's simply because of the returns we're going to earn. And also, listen, I love my family, and when I'm gone, I want to make sure my family gets more than what I've been able to save. So in this particular case, I mean, $3.1 million death benefit. Even when we drop that term rider, we're still 1.3, 1.4 million that gets paid to my family as a death benefit. So listen, like, all things considered, like Dave Ramsey, because we're going to talk about him in a bit, he's always saying buy term, invest the difference. Okay, so in this case, like what we're essentially doing is we're buying death benefit protection like term that never ever ends. But really, what did the term insurance cost me? I mean, you really would just take it, depending on what year you look at, but I mean, we could divide it out any year. I mean, it's still way cheaper than buying term insurance in the long run. Matter of fact, term insurance is the most expensive thing because you're guaranteed to pay a premium and you're not guaranteed to get a death benefit when you die because you will more than likely outlive the death benefit. Here, you can outlive the death benefit, plus the cash value growth supersedes the amount you paid for the death benefit. There's still a cost for the death benefit, but the interest and dividends way outweighs that because of uninterrupted compounding interest. And I wanted to make sure we didn't leave that because there is a value in that. And I know a bunch of the folks on here are like, I don't care about a death benefit, but you will when you're sitting on your deathbed and you're thinking about all the things you did in your life and the family that you're going to be leaving behind. You want your family to be in a better place than you were. Okay. You want your family to be able to stay in their house. You want your family to be able to keep the cars that they have. You want your family to be able to pay off some debts if you have debts when you're sitting there taking your last breath. Like I talk to people all the time and they always say, oh, I don't really care about the death benefit. I know you don't today, but when it matters, you will very much care about it. And I know this because I've delivered so many death benefits, and there's never been a death benefit where I've walked to that person, the person that passed away and went on to heaven. I've never walked to their family with a check and had them say, Jim really didn't want death benefit, so we don't want that check. Like, you can just give that back to the insurance company. Any of you think your family would say that? Like, we really don't want that check. It's so nice of you to bring that out to us, but we just don't need it. That never will be a discussion that anyone ever has. They will gladly take the check from the insurance company, and they will gladly think at that point how awesome it was that that family member took that time to build that protection into their planning. But anyway, we're talking about cash value growth, so let's just get on with this.
Yeah, and Chris, there's some really good questions coming in just on policy design, and we don't want to spend a lot of time on policy design today, but there are some good questions. Ozzy's asking, about the death benefit dropping. What's happening behind the scenes is, in order to prevent the policy from becoming a taxable entity due to the IRS's modified endowment contract rules, there has to be more death benefit in the picture, and we do that with the term rider. So that's why you see this drop off. But then, Ozzy, look what happens year after year. It just keeps going up and up and up and up. So that's essentially what's happening. But there's a lot of design videos out there if you want to learn more about how this is done. But that's one of the things that's happening there. Let's see, the
Andy had a
last.
good question. Like, let's just say somebody set up a plan that looked just like this. And folks, your plan will look different than this. So we're just giving this as an example. But let's say they set it up 20, but then something happened, for the next 3 years, and they could only do 5 or 6 to 7 grand. Can they make up the difference that they wanted to put in those early years when they basically get back on their feet? 100%. Now, there are some rules, but we always build those rules into the plan, and it's simple. You have to do at least, so let's say your minimum is 5602. That's why we rounded up to 6,000. The minimum amount you would have to put in above and beyond that 5602 is roughly $10 a month or $120 a year in order to have that catch up still be alive. But that's getting into the weeds a little bit.
Yeah. So let's move on. I think Thomas, queued us up perfectly, because Thomas says, why is this better than just investing in an apartment building?
Yep.
Right.
All right. So let's move on.
So let's go on to the next piece here. Do you want me to show that, Chris, or do you want to go?
Well, let me just kind of show it on the screen, and then I'm going to have you come back and show it, because I think this is a really important thing. Thomas, thanks for bringing us back. It's so easy to go down the rabbit hole when you get into the designs, because everybody loves the numbers, but like, it's not the numbers. Remember, we said it's not the product that solves the problem. Like, the solution is the process, which is where we're getting into. So now, Thomas, and anyone else that's talking about real estate, so up here, we want more income. So to get more income, let's just say we want real estate. Or you could even say, I don't want to own real estate. I just want to lend on real estate. So no matter what, let's make the catalyst real estate. So what we do is we change where our savings goes first, and we put it into this policy. I'm just going to use that example, 120. Okay. Actually, here, let's just do 100, because it's simple math. You got $100,000 in cash value. You're going to buy a property for 100 grand. Just go with the numbers. It can be any dollar amount you want. I'm just keeping it simple. So what we would do is immediately, and folks, just so you all know, like, a lot of people, when you think of whole life or any life insurance, you're like, yeah, but when I put the money in, I can't take that money out for a year, 2 years, sometimes 3 years. Yeah. In a regular whole life policy that your broke-ass brother-in-law sold you, that's the case. But in these specially designed policies, you have liquidity in your policy immediately in the first 30 days. Really, it's when your check clears. So it's kind of like when you go to your bank and you deposit a check. When is the money available? Well, some banks it's 5 days, some days it's 7, some it's immediately. It's when your check clears. No different here. We just say immediately in the first 30 days. So within the first 30 days, you identified a property that you want to buy. So what we do is we take a $100,000 loan from the policy. Now, a lot of people don't like that word loan, but you know what? When you go to a bank to buy a piece of property, what are you taking? A loan from their bank. So if you're going to be the bank, you got to think and act as if you are the bank. This is your bank. Yes, I know it's a whole life, but this is your bank. This is the start of your banking system. So when we take money from your bank, we are always going to take it as a loan. And here's why. Remember I said there's a death benefit, and let's just use, what was it, 3 mil? There's a death benefit of $3 million. What most people don't realize is the insurance companies, if it's built the right way with the right company, will allow you to access some of this $3 million. In this case, if you had 100,000 in cash value and you took a loan from 100 grand, really what they're doing is they're giving you 100,000 of your $3 million death benefit. So now if you died the next day, the insurance company's only giving your family 2.9 million, because the 100,000 was already given to you, and you took that 100,000, and what did you do? You bought a piece of real estate that's going to provide an income. So let's just say that income on that piece of real estate is $500 a month. Okay. So that's your passive income on that real estate. I'm just giving simple examples, but we took the 100,000 from our death benefit. So what does that mean? Well, that means that your $100,000 in your account never left your account, which is why your $100,000 earns guaranteed interest, 3.25% in that example with that company we just showed, and dividends. So you're upward of probably, between 5.5% and 6%. I don't remember what the dividend crediting rate is, but you got 100 grand earning guaranteed interest plus dividends, but yet you got $100,000 to buy a piece of property that pays you a net of $500 a month, as an example. So how many times are you making money on $1 here? Making money twice. How are you making money twice? Well, your 100 is still earning interest and dividends, and now the 100 bought a property that's turning in income. So let's just talk about some of the most important things, and then we're going to show it. I'm going to have Craig show it. Because you took a $100,000 loan, which was the insurance company advancing you $100,000 of your death benefit, they do charge you interest on that. So right now, and we just got back from a conference, this company just increased their loan interest rate to 5.2%. So right now, this insurance company will charge you 5.2% to borrow part of your death benefit, but that means that all $100,000 of your money is in your account earning more than 5.2%. So how does a bank make money? If we're going to think like a bank and we're going to act like a bank and we're going to do what a bank does, well, then how does a bank make money? Well, a bank takes your deposit. And a bank, let's just go to this screen, and then we'll get back to real estate. If you were going to a traditional bank, a bank pays you interest on your money. We'll just call that 3%. But if you took out a mortgage or a loan, let's just call this a loan for a piece of property, is the bank going to charge you 3% or less, or 3% or more? More, right? They always charge you more. A bank's probably going to charge you about 6% right now. So the bank charges you 6, but they pay you 3. What is the bank making? A spread. The bank is making a spread because they're only paying you 3, but they're charging someone 6, or maybe they're charging you 6. Does that make sense? So isn't that what I just explained here? If the insurance company is paying you 5.5 and they're charging you 5.2, you're making a 30 basis point spread. But if we went back to Craig's numbers and we looked at those numbers, remember the $100,000 compounding, or is compounding up. So that might be the spread out of the whole, the gross spread, but isn't it more next year? Of course it is, because you're compounding, you have more than 100,000 earning interest and dividends. How much is it the next year? More than that. How much next year? More than that. So every year you're compounding on a higher amount and they're charging interest on the exact same amount. But here's where it gets super fun. Here's where it gets super lucrative. So remember, we took that 100,000 out, we bought a piece of property. That piece of property is going to pay $500 a month. We're making a spread over here. So we make a spread one time now on our money. We earn more than we pay the insurance company. So we are doing what a bank does. But now we got this property that's paying us a net income of $500 a month. If you owned a bank, where would you deposit the $500? Would you go down the street to Bank of America, or would you walk into your bank and deposit the $500 in your bank? I mean, this is kind of silly. You would absolutely put the $500 in your bank. You would never put the $500 in someone else's bank. So what we do is we recycle and recapture the earnings from that property, from your property that's now printing money for you or providing income, and we're going to put it back into the policy. When we do that, if we take the $500 and put it back in our policy, how much money do you think you have the next day? $500. The next month, when you put $500 in, how much do you have? Another $500. Completely liquid. You lost no liquidity here. You made a spread. But now, didn't you make money a second time? Yes, because now this $500, that's you making money a second time. The spread was 1, and this is the income number 2. But now, and we have the calculators. We're not going to get into it today, but I just want you to listen very carefully. If this $500 that's going back in is completely liquid, what is it doing? Well, it has to pay down the loan because it's not part of the original savings. It's not the 20 grand or the 99 grand. This is above and beyond. Then the $500 a month that goes in is paying down the loan or repaying your death benefit. So because it's paying down the loan and the insurance company is charging you 5.2 next, the first month, are you paying 5.2 on 100? No, you're paying 5.2% on 100 minus the $500 you just put back into the policy. And every month you do this, you're repaying the loan, which means the insurance company is charging you interest on a lower balance while your money is earning interest going up. So one is going up, one is going down. What happens to your spread? This is just math, folks. It has to go up. Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you, privatemoneyclub.com. Back to you, Chris. So when you talk about being your own bank, this is not hard. We are doing the exact same thing a traditional bank does. The exact same thing, except for now, we're not giving the spread to the bank. We're keeping the spread. And then any of the additional money that's earned, we're putting it back into our bank. We're just creating a circle. We're creating a circle for your money. Think of Monopoly. Your money, or in Monopoly, you go around the Monopoly board, and every time you pass go, you do what? You get $200.
200 bucks.
Every time you go around the circle, which is every year, you get a dividend. And that dividend continues to compound uninterrupted. And also, here's the other thing. And I gotta hit this because this is something very often misunderstood. And there's calculators for this. So if the bank's paying you 3%, at the end of the year, what does the bank send you? What does the bank send you at the end of the year? It's called a 1099. And they send you a 1099 for the measly 3% interest if you're even earning 3%. So the bank pays you interest, but this is taxable interest. So now let me just ask you this. If you earned 3% taxed, and if you earned 3% tax-free, keep it the same, what is the tax equivalent yield your tax dollars would have to earn to get the same thing as the 3% tax-free? It depends on your tax rate, but it's probably closer to 4 to 5%. You would have to earn 4 to 5% to equal the same amount as you would earn making 3% tax-free. It's called the tax equivalent yield. So remember earlier, I started the whole life, and all the gains in the whole life grow what? Tax-free. So therefore, if you're making 5.5% gross tax-free in the whole life, if you put that money into a bank, that bank would hypothetically have to earn roughly around 7%. Again, check with your CPA or go in and do a tax equivalent yield calculator. I'm just making numbers up, but that's probably about what it would be for some of you in your tax bracket. It's all depending on what your tax bracket is. So already, because we're in a tax advantaged environment here, your money works harder for you just for that. You're not leaking any to taxes. Here's another interesting thing. Let's just say come November, Kamala Harris wins. One of the things she had talked about is taxing unrealized gains. Taxing unrealized gains, meaning if you've got gains in your stock portfolio, they potentially would tax that. Now I know it's for like 100 million, but you think it's going to stay there? No, it's going to come down. But I'm just hypothetical. I'm just keeping this simple because this question actually came in and we'll answer it on Ask Me Anything. These policies are completely private. There is no tax reporting at the end of the year on these policies at all. There's no 1099s. There's no K1s. There's no tax return. The government doesn't even really need to know that this exists in the grand scheme of it. So if this did all go through and taxing unrealized gains became a thing, would you have to pay tax on the unrealized gains in your policy? Well, I don't know the actual answer to that yet, but I would think no, because there's no reporting, so they don't even know what your unrealized gains are. So what are they going to tax you on? Anyway, let's move past that, but I thought that was an interesting thing. Is there any questions coming in? I see Ozzy's got a few. I don't want to move on to the next segment until we make sure all these questions are answered.
Yeah, and just a quick note about questions. If you do have questions, please put them in the Q&A. It's a lot easier to find. I've been watching the chat. I don't see any specific questions right now. If you do have them and we've missed them, put them in the Q&A, please, and we'll make sure we get to them.
I love what Andy said here, the last chat, is he said tax equivalent yield may be a good additional thing to figure out for IRR calculation. So we've got a second, and I don't want to take much time on this, but do you think it's okay if I just pull up a calculator? And watching this real quick, and I wanted to show you how I do this. So right here, these are muni bond calculations, so which is going to be fine. But here, let's say your bond earned 5%. So in this case, let's do 5.5 for the policy. Let's say your policy earned 5.5%. Okay, and the estimated taxable income, state tax income, married, none of this matters, but let's just put single. So right here, all I'm trying to do is if 5.5% were the case, do 100 grand because that's simple math. So here we go. 5.5%, you would have to earn 7.639% in a taxed account. Okay, and if it was, you know, state and federal, so bond tax exemption. So what we're basically showing you here is a tax, oh yeah, 28%. And you can change that on some of these. This bankrate.com one is just basic and used heavily for municipal bonds, but it could be used for whole life. So in other words, your policy earns 5.5. If you went into a taxed investment like a bank account, your bank would have to earn 7.639 if you're in a 28% tax. And if you're, let's see, married filing jointly, 7.33%. So you can play around with these tools. You can calculate all sorts of different things, but this is a really good one. So I did this for Andy because he made a good point that this should be factored into all of them. But Craig, let's move on because we're talking about income and how do we earn more income. So can we just go into real estate and talk about something that I'm really passionate about because I've done all the real estate. I've owned rentals. I still do. And they're always a pain in the ass. No matter what, when people say I earn passive income on real estate, I'm like, bullshit. There's nothing passive about owning rentals because there's always a problem. So I was told a long time ago that the ultimate in real estate is being the bank. So what do we got here?
So we're going to walk through the use case. So assuming we've got, you know, the policy set up, we now have our banking system put in place. We're now going to take a loan and put it into a private lending opportunity. This could be something different for you. You could be putting it into, you know, real estate that you own, you fix and flip. But in this case, we're walking through an example from the Private Money Club. And if you don't know about the Private Money Club, the way we describe that's a dating site for money. It's real estate investors who need money, and there's folks that have money and they meet to do these different deals. Here's one example where somebody's asking for 145,000 and they're willing to put you in a first lien position on that property. So when you loan that 145,000, you're secured by the property and they're going to pay 15% return on investment. And typically what they do, let's say you put 100,000 in and it's 12%, they're going to give you a $1,000 check every month. So this could be for a 9-month project, could be a 6-month project. All of the deals are a little different, but anyway, this is a place to go to find an opportunity to lend money. And in this case, you could earn, you know, around $1,812.50 a month at 145 on the 15%. All right, so let's move on. So let's talk about the process now of how we take the money, the funds out of the policy and we put it into the private lending deal. So in this example, what we're doing instead of, you know, previously we went over about a $99,000 dump in a policy that had a $20,000 premium. In this case, we've got a policy designed where the owner's putting in $100,000 dump in, and then they're doing $12,000 annual premiums. So going into the policy, year one is $112,000, and that's happening immediately. Now we're also making some assumptions in this example where there's a 5% policy loan. Chris shared 5.2 with one of the carriers we go with, but let's just say it's 5%. And we're also going to assume we're getting 12% yearly gain from the lending deal. All right. So we're going to put that 112 in. And within the first 30 days, once the money's cleared, once the full funds are available, we're going to have approximately $93,308 available to take as a loan. So now what we're going to do is we're going to take that loan from the insurance company from our policy using the death benefit as the collateral. And it's going to go into what we call a segregated account. A lot of people get confused. What is this segregated account? It's nothing special. It's just another bank account. Could be at your credit union, your other bank, but it's just not used to buy your groceries, to run your bills through. It's just something separate. We're keeping that separate so we can run the money through just for your own banking system. So we're going to take that $93,000, put it into your segregated account, and then we're going to deploy that to the investment capital. All right. So now I've got a deal where I found somebody that needs 93,000, maybe it's 90,000. The numbers here don't necessarily matter as much. I want you to understand the process of what's going on. So now we've got that $93,000 in a private money club deal where somebody's using that to maybe do a fix and flip. But while they're using the money, they're going to pay us 12% yearly return. They'll probably be paying that out on a monthly basis, but let's just assume that over the course of a year, They've made $11,165 in payments to us. All right. So nothing real complicated so far. We took our money, we funded a policy, we took a loan, we sent that over to the, to the private money club deal, and now we're getting money returned to us in terms of gains. Now, what's going to happen is those gains, that full 11,165 is going to go into our segregated account. And I think this goes back to a question Ozzy asked earlier, is like, when do we pay the loan interest? So this is one way to do it. It's not the only way to do it, but what we're doing is we're taking enough of that gain, which is 4,652, that would be our loan interest, and we're just going to pay that loan interest back to the insurance company. All right, so our principal is not going down, but we are covering loan interest, and we're going to do something with the 6513 that's remaining. We could invest that. This could be retirement income. But in the situation we're going to go through, we're going to reinvest it. All right, so let me just jump over some things here. This is essentially the policy, but I want to kind of get down to showing you what years 2 and beyond look like. So essentially, this is the policy design. We already went over an example, so I'm not going to belabor the point, but we're putting in that 112 in year 1. What's interesting is we've got cash on cash in this particular policy design of 111% in year 2. So where the other one I showed, I think we got our cash on cash in year 3. So there are some different designs. I'm going to just fly through this one because it's the same thing we went through. All right. So what have we done at the end of year 1? We've put 112,000 into our system. We have a net benefit of 109,000. What is that 109,000? Well, that's the remaining cash value. That's our private money club capital, and that's our gains. So we don't quite have all of the money back in our system that we put into it. So we're actually down about 1.89%. So going back to our earlier conversation, someone might go, well, why would I want to lose money year 1? It's a long-term game. We're building momentum, and just wait. You're going to see some really cool things when we get to year 2 and beyond. But don't forget about this death benefit that's coming along for the ride. That's why there's some cost up front. We've got this death benefit to cover. But let's go in and see what happens in year 2. So guess what? In year 2, we're not putting any more dump in, but we do have our premium of 12,000. We're going to put that into the policy, and we're now going to be able to, our loan balance is going to grow to 105,000 because we're going to pull out 11,991. Okay, so we just took the maximum loan. We put in 12. We're able to pull out almost 12, but not quite 12 yet. We're going to take that 11,991 and add it with that remaining gain that we had from last year. And we're just going to assume that we found either another deal or we can put that all into one deal. So we're taking that full 18,000, running it into a private money club. We now have 111,000 out working for us, generating about 13,000 in gains. And you start to see the pattern. Now we've got a little more loan interest because our loan's bigger, but now we've got more gains that we can keep stacking on top of each other. So in year 2, we've put in 124,000. That's what we've injected in terms of premiums, but we now have a net benefit of 131,000. So again, that net benefit's coming from the cash value that's remaining in the policy because we can't take 100% of it. We've got the private money club deal of 111,000. We've got gains. So these are all of the things that we've essentially added to our system. Now we're actually up 5.92%. So after 2 years, we're already breaking even and going positive. All right. I'll go through one more year I'm going to fly through this real quick. It's the same pattern, but I want to kind of get to the summary of it. Here's what's really fun is when you put in that 12,000 in year 2, does anybody notice what happened with a loan? And this is where Chris was talking to earlier, where this is what he gets really excited about is, hey, wait a minute, I put 12,000 in, but I was able to pull out 12,686. That's pretty cool. So he's now pulling more out than he's putting in on a year-by-year basis, and that just keeps adding growth to the whole system. All right, so now we're at 14.29% in year 3, and I think I ran this out to year 10, so I'm just going to run through that real quick. So by the end of year 10, we've got a cumulative return of 99%, but we've got, if you look at it, we've put 216 into our system and we have 430 as a net benefit. And we still have a death benefit of, 386,000. So anyway, that's kind of the process. And remember, what was the solution, or what was the original problem we were solving for? Does anyone remember what was the original problem we were solving with this whole setup?
More income, wasn't it?
More income. Does anybody see how this process just helped us get more income? Any questions on that?
Yeah, I kind of want to make sure we get some questions from some of the folks who are asking about real estate, because listen, like, we love real estate. And that's a very common thing where people are like, well, wouldn't I be better just buying real estate versus doing this? And the thing people need to understand is it's not doing this or buying real estate or doing this or investing in stocks. It's this and that. You don't need to make a decision. This is just changing where your money starts, and you're still doing everything you would do normally. You'd invest in things you know, like, and understand. We're just showing you the mathematics behind why this makes more sense to change where your money starts, simply because the place where your money starts, if it's able to make your money work for you 24/7, even when you get to deploy the money and invest it, in this example, private lending, that mathematically can be solved like we just did.
And, one other thing to think about.
Nicholas said, I don't even remember the problem because it was solved. Solution
Nice.
granted.
One of the other things I think would be relevant, Chris, for the real estate investors is, if you're putting your money into your banking system, taking it out to fund your own rehab, and maybe that property's not cash flowing, it's not rented yet because you're doing the rehab. Do you have flexibility of being able to not pay that loan back right now? So it really puts you in control, because there's no requirement for you to pay the loan back. There's no requirement that you have to even cover the interest charge. And what a lot of folks will do is, once that property starts cash flowing, then they'll start running the money through. So guess who is in control in that transaction? You, the real estate investor. If you're borrowing from the bank, are they going to give you, that leeway to say, hey, we'll give you 6 months, we'll give you 9 months, you don't have to pay the loan back? No, they want their money right away. So it's just another benefit of when you're the real estate investor, you're using your money from your banking system, you will pay it back on your terms. But we do teach you to pay it back. It's just a matter of when and how that happens. It's going to be structured when and how it works best for you. So I think that is all we have on that specific piece, Chris, unless we want to talk about how we solve that.
No, I think the math speaks for itself. And the only thing I want to preface is, like, we have literally created these tools. Craig has created these tools to be able to mathematically prove that this works. So we no longer say, oh, well, we think you should do this versus doing it the way you are. No, we just mathematically proved that this solution is better than what most people are doing out there. So that's, I think, the best thing and the most important thing to realize there. And also, too, just real quick, folks, I do want to preface that a lot of you are asking, is this recorded? People might have to jump off and do something and they want to watch the rest, because we got 2 more topics. One is the Dave Ramsey retirement folly, or we'll call it lemming. And then the last is a car example if we get to it. So if any of you want to watch this, a recording of this, it will be edited and put on my YouTube channel. So all you need to do is just go to go to YouTube and then type in @the Chris Naugle, or just type in the Chris Naugle, and then you just subscribe to the channel and you'll see it pop up. Let's keep this sucker rolling. Craig, Dave Ramsey, I respect the man. I always have, because he helps millions of people get out of debt. But the problem with Dave Ramsey is Dave Ramsey reminds me of that guy who takes in the wounded bird. The bird hit the window. He goes outside, picks it up. It's got a broken wing. He puts it in the cage, feeds the bird, tends to the bird, mends the wing, gets the bird ready to fly, i.e. the parable here is that's the person that's heavy in debt. Now the bird is healed, ready. Like, no healthy bird wants to live in a cage. So what Dave should do is open the cage and say, fly, bird, fly free. But he doesn't. He keeps the cage shut, and he says, hey, now you're in the cage. By the way, now you're going to use only what I tell you to use. You're going to follow my rules, my instructions, only the way I tell you to do it. That's the problem with Dave. His ego has surpassed his ability. And I'm going to prove that. Craig, do you have that video? Could we play that video? This video, I just want you all to know, makes me sick. Makes me sick to my stomach. I did a YouTube, but you're going to see it in a second. So some of you may have seen this video. It's very short, but I want you to really listen closely to what Dave Ramsey says here. And I want, in the chat or in the questions, I want all of you to let me know where the problem is here, if you can find the problem.
Today's question comes from Steve in Oklahoma. He asks, I'm 72 years old and my wife is 70. We're both in good health. We have a combined retirement and Social Security income of about $140,000 a year. We own our home outright and have no debt. We have about $100,000 in Roth and $1 million in traditional IRAs.
Way to go, Steve!
Our wonderful financial advisor is recommending a distribution of no more than 4%. We're looking at about 5% to enable us to travel while we're able to. What is your recommendation on the maximum annual distribution? It's a great question. And they're in a good spot. And so this makes me feel better about saying, sure, 40,000 versus 50,000 on the distribution is what they're really asking, right? On, let's say, the $1 million in traditional IRAs, that's going to be taxable. This doesn't feel like a big portion of the world if they've got, the 140,000 income.
So if the money is invested in good mutual funds and it's making, average market returns of 11%, 12%, why can you only take out 4%?
Just fear, I think, is the main reason people do it.
Why would the
Inflation.
financial advisor say that?
He gets more money? Is that how that works?
Possibly. Or possibly he is a financial planning lemming. You know what a lemming is?
That's an old school word.
These are small rats that run in herds and follow each other over cliffs.
That is the funniest way I've heard to describe financial advisors.
And so, meaning you go along with the crowd. You go along with the crowd. You go along with the crowd. You don't even ask why. You just go along with the crowd. And so you don't want to be sheeple. So here's the thing. That is a standard thing in financial planning, 4%. Because after inflation and after poor rates of return on the portfolio, you're still going to be okay at 4%. But by God, 5%, you're going to sink it. Which is completely asinine. It's just ridiculous.
They're going,
Steve, you are smarter than your financial advisor because you have more money than he does. And you've done a better job than he has. So you can kind of tell him what to do with your money. Be real comfortable doing that. And dude, if you want to pull out 6%, it's okay with me. I think you're going to be okay. If you want to pull out 10%, you're not going to destroy the portfolio because, dude, you're 70. What are you going to live to? 170? You're not going to wind this thing down in 25 years. You're not going to tear the principal up in 25 years even doing that. So you can be in a position to enjoy your life. And so I would suggest 5, maybe 6% drawdown on this if you've got it invested in good mutual funds that are giving you market rates of return. And I also would suggest that your wonderful, that's what he called him, right?
Wonderful. Yeah, those are not my words.
Wonderful financial advisor. Have a good explanation for why he's giving you these numbers. If you're getting an 11 or 12% rate of return, why are you suggesting that 5% is going to destroy my life when 4% does not?
Time out. For Dave, just to school him a little bit, being an advisor for 16 years, the 4% rule that advisors use for withdrawing from retirement portfolios is based on Monte Carlo simulations that have been done for thousands, if not tens of thousands of scenarios, proving mathematically that 4% is the safest path to not run out of money. But yet Dave Ramsey is the lemming. Dave Ramsey says, oh, why your advisor doesn't know what he's talking about. Just get a good return in freaking mutual funds? Anyway, I won't even go there, but wait till you hear what he says a good return is. I think he covers that.
Logical.
1% is not life-changing either way.
Well, it's not logical. There's nothing. It's only based in, that's a standard card you pull.
Industry standard. I am curious, Dave, would you say what's strategically the best route to go using the Roth portion first versus traditional?
The traditional's got a mandatory
distribution
anyway. At 70.5 that he's going to have to begin. And so I'm going to start there and at least do the mandatory. The Roth is tax-free and will pass tax-free. I'm probably going to use the traditional. I'm probably going to go ahead and pay the taxes on it and pull out enough to pay the taxes on it before I touch the Roth and let the Roth continue to grow tax-free because it will pass to your heirs tax-free as well. So that's the good news on that account.
Good deal.
So good question.
The good news is Dave is completely wrong in just about everything he just said there. First off, he's saying mutual funds are going to get a good rate of return, which in his eyes is 11%. Craig, can you pull up your chart showing the very best period of time that we could find in the S&P 500? Like literally, Craig scoured the market, the S&P, to find just the best period of time from a return standpoint. And what'd you come up with, Craig?
I want to show you one other thing I'm getting it queued up here. Have you looked at the Dalbar report in the past?
No. Well, maybe I have. I don't really know.
Let me see if I can find it real quick. I thought I had it queued up here, but I don't know what I did with it. But anyway, Dalbar, if you search for the Dalbar QIB, I think it's QAIB report, what they do is they look at the investor behavior. So their whole point is, even though the market is earning a certain amount of money, the average investor over the last 20 to 30 years gets around 5 to 6% because they sell too soon, they buy at the wrong times, they do the wrong things. So they're not the Warren Buffetts of the world. So Dave Ramsey's over there saying, hey, you can make 12% in a good mutual fund. And the Dalbar report is saying, no, you can actually, most investors are hitting somewhere in that 5 to 6%. So what I'm about to show is going to make that even worse, right? Because I don't know, it's just crazy to me that he thinks people are going to get 12%.
Well, not only that, and then his recommendation, like he's trying to be a CPA and give tax advice. Like Jimmy Davison on here, who is a CPA, probably was jumping out of his chair up and down about that recommendation to take from the traditional, not the Roth first. Anyway, we won't even go there. So here, what do you got here?
So the S&P 500 in 1970 for the following 30 years averaged 10.85%. And some of the best times I can find in the market is somewhere around 11 and a half. But, you know, the 1970 to 1999 timeframe is not too shabby with a 10.85% average. Now, let's just say you've got $1 million. So the start of the year in 1970, you have $1 million and you're retiring. And let's say Dave Ramsey, you know, kind of teaches you to take 8%. So we're going to take $80,000 out of our account every year, because you heard him say you're not going to hurt it. You're going to be able to get by for 25 plus years. You know, basically this is the logic. If you're making 10% and you're taking out 8, there's still 2% in the account growing and accumulating. You're never going to hurt the count, right? Is that true? Does that really work that way? Well, let's let the numbers play out. So year one, we've got $1 million. We take out 80. The S&P 500 that year returned a whopping 0.1%, you know, 0.1%. So we gained 920, but we took out 80. So our account balance goes down to 920. Next year, we have a 10% gain, which is pretty cool because we gained 90,000. And at this point, we took out 80. So we actually, you know, had a positive there. Our account balance went up. Sweet. But you can kind of see the pattern over time. We had a 15%. Well, we had a gain of 133,000, but we only took out 80. So we had another gain. So now we're back up to 984. But cue the doom music, because now in year 4, we've got a negative 17%. We lost $157,000 account value and we took out 80,000. That is detrimental, folks. This is what Dave Ramsey is just glossing over, right? He just glosses over this stuff like it doesn't happen. And so now if we go into year 5 and we've got that negative 29% and we have a almost $200,000 loss and an $80,000 withdrawal, shoot, now we're down to 469. I'm starting to sweat some bullets if I'm in retirement, because I'm thinking, yeah, I'm healthy. I've got a long time to live here, but I don't know how I'm going to stretch out 469,000 for the rest of my retirement. So you can see how this plays out. We run out of money at the end of year 14. We're done. We're bankrupt. We're finished. Now, I didn't put in any sort of taxes and fees, which is real life. There are taxes. There's typically fees. There's other things that are going to drain this account down even faster. But who wants to sign up for this?
Not I.
Well, is Dave right? Or, I mean, did I miss something here? Because I'm looking at this, I'm just thinking, how in the world is Dave telling people to do?
Well,
6%?
I mean, Dave is right based on what Anthony just said. Dave does say eat rice and beans, and then when you're done with rice and beans, you beat beans and rice. So this would fall right in line with Dave being right in what he says. All you should do is take my advice and you'll be eating beans and rice and beans for the rest of your life, because you will be broke, out of money, and your income will not last. So Dave's right based on Dave's teachings. But I mean, mathematically, I mean, we didn't even factor inflation into this. I mean, 80,000, you know, in 1970 doesn't buy what 80,000 would buy in 1983. That wasn't factored. You already mentioned the taxes and the fees weren't considered. And I have to believe that Dave Ramsey's pseudo professional expert financial advisors, that all they are is just paid help, because they pay Dave Ramsey $3,500 to get the certification to be called a Dave Ramsey certified advisor, and they pay him per month or per year to be able to get leads from Dave Ramsey's channels. I'm sure all of those certified financial advisors with Dave Ramsey, they just give all of their time and services for free, right? They don't charge any fee for managing those awesome mutual funds that return 11%, which somebody else also just debunked that. Anthony said the average yearly return for the S&P 500 is 10.73% over the last 30 years. That's, you know, through July of 2024. That assumes dividends are reinvested, and adjusted for inflation, the 30-year average stock market return, including dividends, is 7.998. Dave is yet wrong again. Incredible. Incredible that this man is out there giving this advice and nobody is like turning him in for giving bad tax advice. And also this, to me, is giving financial advice, which he is not in a position to give because it's completely wrong. So Andy said, to be fair, he did say 8%, not fixed 80,000.
And I did look at it both ways. And I guess here's the way we can look at it is if you take out the 8%, in Dave's world, you should be able to take out the 80,000 because it's never going to go below that. But if we do 8%, we're going to be living on a lot less than 80,000 at that point, because as you run those numbers, you might be getting down to 50,000, something lower. So, but
Yeah.
Andy, that's a good point. It does
It is.
change. So in
But
matter
again,
of,
to what Andy said, what Dave Ramsey's saying is eat rice and beans, and then beans and rice. Because if you just took 8% of your remaining balance, like, yeah, you would be eating rice and beans because you wouldn't have very much income to support your family.
Yep.
Nonetheless, all we were trying to do is point out that this is a flawed plan. And then we did a whole nother scenario where what we did is we showed you how you can use whole life, okay, specially designed whole life, inside a retirement strategy, a distribution strategy, so that when you have these down years, so like, for example,
Chris, just one quick point. You might be surprised I've got this, a spreadsheet where I can switch between a fixed and a percentage.
Quite surprised.
But I put the 8% withdrawal rate in there, and for the excuse me, for the first couple of years, you're at 80 to 75. But by the time you get in 7 to 8 years, you're now down to 40 to 50. By year 14, you're living on 41,000. So, you do preserve the count a little bit. You still have a $500,000 at year 14, but you're living on 40,000, not 80. So regardless, I think if we were on the Mythbuster show, what could we say, Chris?
What do they say when the myth is busted?
I don't know. I can't remember. Something about
Kind of like a slogan they say. Busted.
Yeah,
Yeah,
like,
maybe that's it.
like
They're just
busted.
But with that example, here, share your screen again. There's one thing I wanted to call out. So, like, listen, we're not trying to say that you put all your money in life for retirement, but here's where it could help. If you did some of these strategies where you changed where your savings went, and you were using this whole life strategy for everything from investing in real estate, buying cars, and whatever else your problem is that we started with. What is the problem? So, in the event that you had a down year in your retirement portfolio, in those awesome mutual funds Dave Ramsey suggested, what you would do is you would not take money from the investment portfolio. You would take money from the whole life during those down years so that your portfolio wasn't being drained down. So your principal wouldn't be coming down. Yes, you're losing money in your portfolio, but obviously over time, you're just going to wait for it to come back. And you take from the whole life as a buffer. It's a buffer strategy, and they call it a volatility buffer. And then when the markets are doing good and your portfolio is rebounded, you flip back over and you take money from the 401k, the awesome Dave Ramsey mutual funds, when the markets are going up and when you have strong gains. And you just flip-flop during those bad years over to the whole life, the volatility buffer. And then when good years, you just take from the portfolio. So doesn't matter. I mean, yes.
Yeah, got it.
All I was saying is, like, here in that year when the market's down 17%, you no longer take money from the portfolio because you can see the impact. And the next year when it loses 29, you're no longer taking money from the portfolio. You're taking your income, your 80 grand, from the whole life. So I did a whole YouTube video on that too. We don't have time to get into it today, but that would prevent you from being busted. And that's just a much better strategy. But Dave Ramsey hates whole life and doesn't even understand specially designed whole life, definitely doesn't understand the infinite banking concept, but says he understands it all and that we're all fools and he's awesome. We're the lemmings and he's, I don't know, who knows? We're the sheeple. Whatever is going on in crazy Dave Ramsey's mind. It's just, I just keep having the opportunity to prove him wrong over and over and over again mathematically. All right, Craig, well, we're right at time and we wanted to show them the car. So we're losing people here pretty quickly because we are at time. So why don't we save the car example for the next time? Is that okay, everybody, folks? Did you get enough today? I know we threw a lot at you. I don't want to overdo it, but we did have one more topic and we were going to just show how it works with the car. But we're going to do that on the next Wealth webinar. Fair enough? So folks, join us this afternoon at 4:30 Eastern for the Ask Me Anything happy hour, where you can ask any questions to our entire team. And how you get registered for that is you just sign up and go to my YouTube channel, subscribe, and click that little bell, and then you'll be notified right before 4:30 that we're going to be going live, and you just join us right from YouTube. So that's how that happens. But folks, hopefully we gave you plenty of information for you to think about, plenty of information for you to ponder. Again, it's not this or that, it's this and that. If any of you want to book a call with one of our money mentors, I just put the link up. I've been putting it up the whole time. So that'll kind of allow you to talk to somebody about your problem, and then we can help you structure a solution. The one thing you will not find on that call is someone trying to sell you something. So if you want us to help you, you will have to ask us to help you solve the problem. That's just how we roll and it's how we do things. But folks, thanks for joining us for this week's episode of Wealth Webinar. Craig, thank you so much for your hard work and time with all those awesome spreadsheets. With that being said, we'll see you on the next time. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.